Hey there, this is one of my favorite topics, and again, it's a Warren Buffett saying. He says, rule number one of investing is don't lose money, right? And it's that important that rule number two is don't forget about rule number one. So whether you like Warren Buffett or not, it is really important to look at the downside of your investments. And every investment does carry risk. A lot of people think that they're geniuses when the stock market has gone crazy like it did in 2020 and 2021. But, when you look at the up years, the average of the stock market is around 15% per year, which sounds amazing, right? Everybody's a genius. But when you look at the down years, actually returns go down to about 7 to 8%. So volatility, downside can really kill your returns. And it's really important that no matter what you invest in, whether it's real estate or stocks or any sort of alternative investments, that you're considering the downside. So I want to talk in this video about how to avoid losses. So let's jump into it. All right. So I wanted to say I am not an investment advisor anymore, and I'm not your investment advisor. So get your own investment advice, make your own decisions. This is just my opinions. So the first thing is that losses kill returns, right? If you have losses, it will absolutely destroy your returns. If you have a 50% loss in any investment, it takes a 100% return to get back to where you started. I'll illustrate this. Let's say you have $100 and you invest and you lose 50%. You're down to $50. Well, $50, if you have to have a 100% improvement, right? From $50 back up to $100 in order to get there. So if you just have equal losses and gains, meaning you gain 5% one year, you lose 5% the next year, you gain 5%, you're actually going to be continually losing money. So losses are really, really important to consider. And I think Warren Buffett also said this. He said it doesn't really matter what you invest in, right? You're going to invest in a lot of different things over your investing career, but if you can just avoid losing money, it will really help you. I got to tell you this story about how I lost a lot of money. I lost $70,000 in one day. Was that a bad day? Yes. And I was sitting in my hospital scrubs because I was working in medical sales, going into surgery, and I was on my computer in my car outside the hospital, and the market had closed, and I realized I had lost $70,000 in one day. And can you imagine how you'd feel? I felt like I was this tall. I felt like a failure. I felt so disappointed and angry and upset. And you just imagine, what would you say to your spouse? What's the self-talk that would be going through your mind? And I did. So losses obviously have a psychological effect too. And I was using this options trading strategy. You can see this options trading strategy that I was using. It was not a very simple strategy, right? But I learned something that day. I learned that, that's probably not the best seat on the bus for me, right? Is doing a complex options trading strategy versus multifamily. Now we've raised over $25 million. We've got $200 million in multifamily real estate. And learn that's really a good fit for me. So whatever you invest in, and if you do options trading, that's great. Just consider your downside, right? Consider what's there. And then the other thing I want to say is with inflation, everybody's interested in inflation, but you can actually be investing in something that is a decent investment. You're getting a positive return, but you're actually losing money. What do I mean by that? I mean, let's say inflation at the time of this video is 8.3%. At least the official number, it's probably more like 15%. So let's say you believe inflation is 15% and you're investing something that gives you 10% return per year. 10% sounds pretty good, but in reality, you're actually losing a real return of 5% per year because inflation is eating away 15% of the value of your money. So it's something to consider too. When you look at returns, is just to avoid losses. So that's why I position myself in a lot of inflation hedged things, such as real estate, such as precious metals, such as other things that no matter how much money they print, they're always going to have value, right? It's going to actually keep pace or even get ahead of inflation for various reasons. So that's the first point. The second one is to always consider your downside risk. We touched on this just a minute ago, but I shared about my options trading strategy and what I did. And there is so much downside risk in a lot of investments. Some, it doesn't seem like there's any, but everything that you call an investment, it always has a downside risk. And your job is to determine what that is. Now there's a saying from a movie, I believe it's Rounders, it says, you're trying to, at the poker table, if you're playing poker, because this is a poker movie, and if you're at the table and you can't figure out who the sucker is at the table, then you're probably the sucker, right? So it's important that you determine in every deal, if you don't see a downside risk, then you're probably just missing it, right? Because every investment that we do, every multifamily deal, we're in an ATM machine fund, I invest in self-storage, I invest in other things, there's always downside risk. Nothing is guaranteed, nothing is sure. So your job is to really figure out what that is and to try to really figure out how you can limit that, or is that not going to come into play, but there are always risks in every investment. And so one thing we do in our deals, this is an example with our multifamily deals, I keep pointing over here because this is a deal we did in Jacksonville, Florida, that's turned out really well for us, is that what we're doing is we're trying to be conservative on our projections, right? So you can make the numbers say whatever you want them to say. I read a book in college saying how to lie with statistics, right? And there's also a saying that 97% of statistics are made up on the spot. And I just made that one up. But anyway, the idea is being very conservative as you go forward, right? So these aren't just made up figures of what's going to happen and how it's going to be perfect and how you're just going to be able to do everything you want to do and nothing's ever going to go wrong and the sky is always blue. That's not reality. You're going to have things come up. You're going to have a pipe burst. You're going to have things don't go as expected. The market's going to change. So how do you project that? So two things we look at a lot is rent growth. Even if rent grew 20+% per year in the market, we're never going to project that. We're going to project like 3%. Or maybe we'll predict no growth. Or we'll predict that it's not going to grow much or it'll be negative. So you got to be very conservative on that side. Also, when cap rates at exit, that the market's not as favorable when you're trying to sell. So those are things that are important. And then another thing I want to say, that the last thing kind of about this is to find DHANDHO investments. And you can say that word with me, DHANDHO, right? It's DHANDHO. And I've got this book here, and it's called The DHANDHO Investor. I don't know if you can see it if it's too shiny, but it's The DHANDHO Investor. This guy's name is Manish Prabrai. He's also a fan of Warren Buffett, who we're kind of talking about today. And this is basically, he looks at these DHANDHO investments, and he talks about this idea of heads I win and tails I don't lose much. So if this goes well, I'm going to double or triple my money. And if it doesn't go well, I'm going to at least keep what I have, or I'm going to lose very little, right? So heads I win, tails I don't lose much. Now, again, with my option strategy, I was making money, but I didn't realize that, even though I was making maybe $5,000 a month and I was doing well, that there was a downside risk of 15 times that, right? So I didn't realize, or maybe I realized it, but I thought, oh, that's never going to happen. So it was a good learning lesson for me, right? So a lot of these lessons we have in losses, they actually teach us how we should invest. So look at that, heads I win, tails I don't lose much. I mentioned about multifamily deals. We try to find deals that we have a lot of upside in. For example, some deals we've been working on, we'll see the average rent currently is $900. At least this is 2022. So, and we have 1,000 units in Jacksonville. So when we see an upside of, hey, the going rate for these apartments in this area is $1,425 after renovation, we know that's an over 50% upside, right? So there's very little downside. We think that rents, could they go down? Potentially, but we're already seeing in the market, as long as we can put $10,000 in per unit, we can do these renovations, we'll be able to take advantage of that. So we're very excited about that. And then I also like owning physical real assets, such as metals. So I own real metals, which I think are great, because no matter how much money they print, an ounce of gold is still worth an ounce of gold. This is not actually this is a door stopper, but it looks like gold. But anyway, so owning physical metals is great because it is a hedge against inflation, right? It's something that you have, I think, lower downside, even if it goes down temporarily in value. So a lot of people gamble on what they do. I would say don't roll the dice. Do something that is going to be good for your financial future and really try to eliminate the downside. Even if the returns may be a little less, at least in the beginning, just try to do something that for the long term is going to help protect you from things like inflation and protect you from investment losses. So I want to share this quote with you, which I think you're going to like. It comes from a contemporary of Warren Buffett's. This guy's name is Ben Graham, and he was a stud. He has this to say. He says, even the intelligent investor is likely to need considerable willpower to keep from following the crowd. And he wrote this book called The Intelligent Investor, but he basically was saying, hey, it's hard to go against the mainstream, right? It's hard to not follow the crowd, particularly with investing, but that's really the time sometimes when something is deeply unpopular, people say, why in the world would you ever invest in that? That might be the best time to invest in it. So I want you to check out this video here. This is, we're talking about downside or risks or other things. Check out this video about rising rates impacting real estate. I did a video here. I think you're really going to enjoy it. I think there are some concerns there, but I also think there's some real positives, especially in a time of inflation. So check that out. And then I want you to comment in below if you're willing to be vulnerable with us in our community. I'd love for you to stick in the comments, what's something you have lost money on, right? I shared a little bit of my $70,000 loss. That's hard to share that story, but I shared it with you just because we're that close now, right? But I want you to put it in the comments, what's something you lost money on. And thanks for taking the time to educate yourself. It's always a joy to do these videos. We'd love to interact with you, and look forward to seeing you on the next video.